Hello, Warriors. Alexander, how are you? Hank, welcome to F.A.C.E. Thank you for joining us. Who else is here? Hi, Richard. You didn't beat Alexander. Sinatra. Good afternoon. Hi, DJ and Hugo. Everyone doing okay?
Good morning. Good early morning, Blake.
How are you? How you doing there, K-Man?
Yeah, good. Back after a few days off, so.
Yeah, glad to have you back. In fact, why don't we talk about what's happening here? We got new highs in US dollar yen.
Yeah.
Let me pull it up here. And yields did not make a new high. So here's the yen. I'm shorting gold at 1980. All right, so there we go. And it's at one of, based on my fibs, it went to one of, Blake's favorite extensions. I don't know what the extension is from, probably from this.
Yeah.
But the only thing I noticed is, although the yen made a new high, so far we have a failing rally after yesterday's reversal in the 10-year. And no one thinks rates could head lower now going into the Fed in May. So I think this could be a surprise.
Yeah. Yes, because we've had a bit of an example of it overnight on the RBNZ, right? They hiked 50 BPs, and yet the longer end on the
yield curve
actually came off.
Yeah.
But there were a couple of lines in there that they only that they really front-loaded rate hikes in case something bad happens later, and it's mostly inflation-related, a little bit like the Bank of England's Bailey did the day after their interest rate hike with the sterling, and sterling came off as well. So we have a couple of examples where central banks are hiking, but the currency actually does not hold its strength.
We're going to have a great guest to talk about that today, came in. Do you remember Danny Blanchflower in 2008, huh? He was the only dove, and no one saw the Great Recession coming, and he just wrote a piece. A lot of people are talking about that recession could be a year and a half away. He believes we're in one already, so stick around for that at the bottom of the hour. And Danny's very, passionate still about what he does as a labor economist. So we'll get some things. Maybe he'll be yelling at the central banks to tell him to stop.
I'll hang around.
Huh?
I'll hang around to listen. I remember Danny Blanchflower from the BOE, but I was at banks. So.
Yeah, what they call those instead of Fed governors, MIPs. Is that what they're called in England? If you're on the board of the BOE.
Monetary Policy Committee, you mean? MPC.
Oh, MPC. What do they call those guys instead of like Fed governors? What's the analogy?
MPC members. I don't know.
Okay.
Do they have a name?
Okay.
But I have to say though, I was market making sterling rates when Blanchflower was on the MPC, and he was one of the two people, I've said this before, he's one of the two people I would listen to every word he said. The other person being Andrew Sentence, who was the Uber hawk. So I would listen to those two guys to see the two opposing sides. And but the MPC at the time, the MPC at the time though, there were dissenters, but they would almost always side with the chair, basically. So the governor, who was it then? Oh my God, I forgot now. It was after Eddie George. Oh, I'll need to remember. But yeah, it was.
He had enough after that term.
I mean, he was in the crisis, right, and all that. So, a very, very smart guy. I mean, really smart guy.
You mean?
Mervyn King, there you go, Mervyn King. Yes, very smart guy, Danny Blanchflower. Obviously, he's kind of biased in his opinion, always has been, but really smart guy with very good arguments. And if you look in hindsight, he was right and everybody else was wrong with the crisis. So very, very good guy to listen to.
Yeah, and his heart goes with the workers, okay, because he's a labor economist. So he really thinks about what could happen to the average guy on the street and how Fed policy will, you
Yep.
know, detract from it. So we're getting a fade in the S&Ps here pretty good. Any news, guys?
No,
I mean, it's come off like 20 handles
no.
Same as yesterday,
in a
isn't it?
hurry.
Same pattern as yesterday.
Yeah, I mean, we have
So-
producer prices today, right? So, I'm sitting there, and good morning, everybody.
Good morning,
I mean,
Blake.
good morning. We have PPI coming out, and people are probably looking at the reaction yesterday following the CPI data, and they're like, yeah, I don't know if I really want to be long. I mean,
Yeah,
you saw the
Yeah.
market got completely
Gave it all back.
yesterday following the CPI data. So,
And you
Please.
know that inflation globally is not going down. You saw UK CPI come in from 6.2% year on year, expected 6.7, came in at 7. So, and PPI input 5.2% month on month, 19% year on year, up from 13.9 expected. I mean, these are numbers. These are not. Anyway, they're scary numbers.
it's really a really scary number. Dale, here, I can go ahead.
Go ahead,
and take
bud.
the chart if you want me to. Look at equities. This is our long time chart. I think I've had that chart. I have two S&P charts that I work from. All right. I have this one that I work intraday stuff from. This one is kind of like my longer term, roadmap, if you will. We've had this drawn just like this for how many months? You guys have seen it, probably like once every
5-6 months.
Yeah, I mean,
Or
it's been a
longer.
long time, and it's still working as expected. This was the only the move that we had above the 4,600 is the only thing that really kind of caught me a little off guard. I didn't think we were gonna take that out, but anyway, you look at the S&P now, and you're right, Stelios. This is real data that we're seeing, real numbers, and it's numbers that are going to weigh on the market. So, as far as PPI goes, now remember, for those of you that are not aware, when you have producer prices, if they run hot, usually that trickles from producer to consumer. So, we want to see. If there's a lot of people, who is it, like Goldman Sachs and who else overnight called inflation, said this is peak inflation? Goldman and some other big bank last night. Do you guys recall?
I don't recall now.
Okay.
Mike Delfino is saying JP Morgan and Goldman.
Oh, Mike. Okay. Thank you very much. Yeah. JP Morgan. So therefore, theoretically, what we should see is some, moderate prints today. And so if PPI comes in, better than expected, better meaning that, it's going to be not as hot of a print, stocks are going to recover. I think stocks will recover. Dollar will get hit. But are you guys watching the reversals that we saw in the Kiwi overnight? We were talking about how important. So let's just, I want to point something out. Intraday, if you guys are Forex Analytics subscribers, right? We do this bias chart, right? It's a bias. We go through all of the major markets and kind of identify all the major currencies and some of the bigger markets, identify where those key levels are at that we need to be aware of. And overnight, the Kiwi post RBNZ, you can see Kiwi spiked to the 69 cent resistance level following the rate hike, and we saw a massive reversal from there. And as K-Man just pointed out, the risk is for Kiwi longs is they have actually front loaded the rate hikes, and that's something that we talked about yesterday. I'm like, hey, if they go half a basis point, but they say they're just basically front loading the rate hikes, we're going to see a reversal, in the Kiwi after initial spike higher. This is something that we talked about both in the morning edge yesterday and the daily roundup. So if you guys are Forex Analytics subscribers, you knew how important this reversal was. And now that they've done that, the question is, and I got to ask you guys, do you really want to own at this moment, and I'll tell you, like overall, I'm a bull when it comes to these. But do you want to own the Aussie and the Kiwi right now? Look at the Aussie dollar. We had that false breakout. We've seen that reversal. Now we're going to get into dangerous levels if you own it, because if the Aussie starts breaking through, let's call it like, well, I've been looking at 74 cents, but now it's more like, 73.80 roughly. You get back down below this trend line, and you're gonna see some air come out of these commodity currencies. So what do you guys think here about like the price action in the Kiwi and the Aussie? And any thoughts there, Kman?
I think a lot was about positioning, and then the warning that or the confirmation rather that the central banks are hiking mostly because of inflation, but they are all hiking, right? So apart from the ECB, but so far. But if the reason is only inflation, then you're fighting something with the rate hikes. You're not hiking rates because the economy is doing so well, and that's what the market read into it. I have a bit of difficulties to see the next 100 points in Kiwi or in Aussie, to be perfect myself. I've been out for a couple of days, but I don't know where they will head to. Are they up or down? It's a flip the coin for me.
Yeah, like you guys probably know this. I mean, most people know this. I am actually an Aussie and Kiwi very, very big bull, but I don't want to be bullish right now. There's a difference between being overall bullish and being bullish at this very moment. And right now I'm not very bullish. I'd love to buy the Aussie on an approach towards like 72, 73 cents. Somewhere down in this neighborhood would be optimum for me to be on the long side, somewhere down here. I'm not saying that right here. So just somewhere. And all the stars have to align on a move like that. But if you look at the price action right now, like I look at this Kiwi, and this Kiwi looks like we could probably trade back down towards 65, 60, 66 cents, somewhere down here. That looks very doable to me right now. And then let's talk about a little bit about the Canadian. Look, the Bank of Canada is expected a 0.5 basis point hike today. And, I'm sure anybody who's long loonies right now, like, short the dollar, I'm sorry, I should rephrase that. Short dollar Canadian, long Canadian dollars right now is watching what is happening with the Kiwi overnight. I mean, this is not a small move for the Kiwi. This is let's just talk percentages here. From the high, that's an almost 2% move in the Kiwi dollar, which is unheard of intraday for the Kiwi. Kiwi we can do, maybe do, 1%, and that's a pretty big day. This is an outsized day for the Kiwi dollar. And if you're long Canadian dollars, that means you were expected the dollar Canadian to go down. You're probably looking at today's price action going, oh crap, and to top it off, let's just talk about the dollar Canadian technically really quick for those of you guys that trade the Canadian, right? We had a wedge. You can see the lower dotted trend line, right? This one right here, right? So we had this lower trend line, the upper end of the wedge. This is a wedge we broke down. We had a false breakdown last week below the 124 level. Now we're back above the 200-day moving average. Shoot, if we get much above like 126.70, and we're at 126.53 right now, we get much above here, you're going to start to see the squeeze party come in, right? You're going to start to see the squeezy Charmin Fresh, if you guys remember, like back in the Charmin toilet paper commercials. Yeah. Anyway, that
was it with the little bear.
Dale may be the only person that remembers that right now.
It was with the little bear, wasn't it? The advert.
Yeah, squeezy, Charmin, the bear. Anyway, you got it.
Two plies, Stel.
Anyway, so we get much above like this, like I said, 126.70. We're going to start to see a squeeze in the dollar Canadian just from a probably positioning standpoint, right? And remember, the Bank of Canada is how long from right now? We have the BOC in less than 2 hours from this moment. So just keep that in mind if you're trading the dollar CAD. So what else is on your radar now? I have to say, Kman, you've been out for a few days. We've missed you. It's good to have you back. Ryan is out. He's watching. Who's he watching?
He's going to the football tonight. Yeah, Lyon from France versus West Ham. So he's a big fan.
He went to watch West Ham and who?
Lyon.
Oh,
Lyon,
okay. All right. And he's in France right now. So Ryan took off to go watch football. That's exciting. Or
he might be visiting Macron to congratulate him on his first round election victory.
So, hey, how are you reading well, we can talk about the ECB here in a second, but how are you reading into the French elections right now? Anything that, stands out to you?
Well, I think the worst fears are a little bit alleviated. Macron did survive the first round a little bit better than feared. So now it's all going to be about the second round. It seems that he's already on the scene, trying to talk to the French public a bit better than he did it before the first round. It looks from the outside that he might clinch the victory again. The extreme left, Mélenchon, who came in third, already said anything but Le Pen, which is roughly like during the prior elections, and he has a 20% if all his electorate follows him, of course. He can add a 20%, 21% easily to Macron's vote. So he should, in theory, be in for a second term. Now it's the French elections. We never know what happens between now and the 24th, right?
Right. Yeah.
But in theory, the worst fears are behind us.
Well, let's see if we can. Let's see if we can shake the bearishness that the euro. It's like the euro is really underperforming right now. By the way, Hank writes in America, football is not soccer like the rest of the world. Oh, I understand. Look, I'm a soccer family here in the United States, which we're becoming more common, believe it or not, the last couple of decades. And I was telling Kman in the chat room, if you guys are not familiar with the Forex Analytics chat room, this is our community, by the way. Just you can see all the charts and everything we post. And Kman and I were having this little conversation a little bit earlier about soccer. We were talking about that. And one of my son's teammates is going to try out for Crystal Palace this summer. So he's so hey, in the United States, we produce some decent soccer players, or football in your instance case.
Have you?
We can sometimes.
Oh yeah, there was a guy in your national team who was really good. Who played.
There's like one every decade or so that we can produce. Hey.
Nice.
Anyway, so going back to the euro. So how do we position for the ECB? Look, I'm long the euro, and I'm not happy about it. It trades like absolute garbage. Like I mean, I'm thinking. First of all, the euro's got to start turning higher against some of these crosses, and like if you look at the euro sterling, it's trading really heavy. It's still around the 618 retracement. You look at the euro Aussie, can't get above that trend line. You can see it right there. Oops, not there. You can see that trend line right here. That needs to happen. Now the euro Kiwi finally broke out. I was expecting that to happen. So we're above that, but that's obviously Kiwi related more than anything. And then maybe we'll get a move in the euro Canadian later today, following the Bank of Canada. But you can see it's still trading really heavy as well. So, do you guys have any thoughts going into the ECB tomorrow? I mean, I'm long the euro just because I know technically where I'm wrong. I just don't. I feel like I'm wrong already because it's trading so heavy, and it's just not trading well. Any thoughts on the ECB?
Personally, I said this a couple of days ago. I've got a tiny long in euro pound, down about 30 pips or so, just like a tracker basically position. I said yesterday I want to be going long into this because I think the risk reward is very good for.
Well, okay, so I remember, and I'm gonna cling on to you guys as some of your words from the beginning of this year. You said that the euro would be the best performing currency, well, it would outperform the dollar this year. Do you still feel that way?
Well, we couldn't predict the Ukraine invasion, could we? And you have to say that a lot of the weakness is because of that. I still think so, although, I would have preferred it not to have been this way.
Yeah, right. No, I understand that. Kman, you have any ideas about the euro going into the ECB? And by the way, I want to pull this out with the dollar index. The dollar index finally hit the 161% extension of this last range. We were kind of waiting for it. I was kind of on the fence whether we were going to hit it or not because it was the top end of this channel, but we hit it, and you can see how we're just kind of stalling there. We haven't shown a reversal. It's just we're just stalling there. But Kman, you have any ideas here?
Well, so far I still couldn't buy any euro. I think the key is more those euro crosses, as you pointed out, than the euro dollar itself. Although 108, we all know 108, 107.85 is a big level. So we will see tomorrow after the ECB, and I'm prepared for the worst because I bought some downside 107 and 106s until after the next FOMC, in case we get like a quick spike lower. They were very cheap actually when I put them on, but I wouldn't mind like picking up some on the next big drop if we see one. So there's euro dollar, and then there's those euro crosses. Euro dollar is here also because of the euro crosses, right? Euro Kiwi, euro Aussie, euro, well, you name it. Euro versus EM has been absolutely slaughtered, right? Euro Max, Euro Rand, you just name them. They have been slaughtered. So a part of the key is going to be there as well. Now, is Lagarde going to finally sound hawkish tomorrow? It could be, but if it's only due to inflation, then we are again with the same problem that we have in the Kiwi and the sterling that we saw when Bailey said the day after the Bank of England, when people were jolly buying sterling, he said like, no, but we're only raising because of inflation. And look what happened to the cable then. Cable absolutely got crashed. And if Lagarde goes to say, oh yeah, we're a little bit more hawkish and we are going to stop the APP, what is already expected anyway. But if we raise, it's only going to be due to inflation. I don't see how a euro can all of a sudden start to correct, not even get bullish, but to correct all those heavy euro crosses.
Yeah, I mean, we're looking at the Euro Max right now. I mean, just absolutely destroyed. One of the I was actually just looking on my other screen here. I was just looking at the Euro Norway, just because well, let's talk about let's talk actually about crude oil. Crude oil is struggling up here. Even though we're above 100, it's still I wouldn't say it's really capitalized on the move back above 100. It just kind of is holding. But take a look at the crown here. Look at the U.S. dollar Norwegian krone, a nice little base. We just broke above resistance. I'm talking like literally within the last hour here, really starting to make a move. And you can see the euro. Well, this is one of those crosses that you're talking about. Here's the euro NOK, and this is one of those that can actually show a little sign of life here, especially if crude oil starts to show some weakness. Anyway, just a little heads up, guys, if in case you're watching. But yeah, I'm just surprised how heavy this euro is just trading against so many different currencies. It is wild. Oh, speaking of which. And we got about 6 minutes before the PPI data. I just tweeted the pound New Zealand. This is something that a couple of us have been playing overnight, as it was near the 174 level. I'm actually looking to add to my position now long. on the pound Aussie. I love these when you get and I tweeted about it. If you guys don't follow the Forex Analytics Twitter page, I'm actually, I post all of my technical setups there. So, on Forex Analytics, and Ryan and Kman both, they tweet a lot from there too, a lot of the macro stuff. But one of the best setups I think right now is this little false breakdown, got everybody short. Now we're going to show a reversal above 176, should take us back to 180. So, I mean, on a breakout above 176, nice setup. And this avoids the ECB tomorrow. It avoids, well, we're past the RBA and RBNZ. So now it's all about, we get above 176, this thing should take a little bit of a move higher. So keep an eye on it.
Blake,
yep.
Sorry to, if you finish, I would just want to say a couple of things.
Yep.
Okay, one, we have some people who are saying, oh, the French election is going to be close, it's a risk. I think we're going to see exactly the same as the last election, where actually last time it was tighter in the first round, from what I remember, between Le Pen and Macron. I think it's going to be, they all get together, anything but Le Pen in the second round. Yes, it's not going to be a landslide, but I don't think there's any trouble. And frankly, if the market was thinking that there's any chance or any decent chance of Le Pen winning, we would have seen the euro a lot lower than here. So that's one. The other thing I want to say, you guys know I look at weekly and monthly charts. Look at the 10-year US yield, 200 DMA. Today it's breaking out, first time since 1987. So I have friends who are saying, how much more do you think this yield thing is going to go? It's overdone. Just take a look at that chart, and I think we're definitely not done. So just something to think about. And it's in human nature to want to go against a trend. Oh, it's overdone. It's gone too far. Yeah. In the short term, maybe you might get a nice little reversal. But man, I don't think this is done. Not by a long way. But yeah, I've been wrong in the past.
Raining on our parade over here. I want to see rainbows and unicorns.
Rainbows and unicorns.
Rainbows and unicorns pooping out rainbow poop would be awesome. It'd be awesome. Anyway, we got asked, do you think the PPI is going to be a mover today? I do, especially after yesterday's move. So matter of fact, let me go over to Forex Analytics. If you guys don't know, this is the actual platform. Really quick, I'm going to take just a moment. That if you guys haven't checked out, well, first of all, try out Forex Analytics. It's $1 for 10 days. This way you can jump in our community and really, talk to us, because this is just since I got up, just so you guys can see. And it's a very slow market right now, very slow. So I got up right here where it says, Blake, good morning. Blake, good morning, good morning. That's when I came in. That was an hour ago. Hour and 15 minutes ago. That's when I got in front of my computer at like 3 something in the morning. So as you can see, a lot of chatting going on. This is like the macro chat room, the Flownomics room, trade room, where we post like positions, news and research. Obviously we upload a lot of research there. We have a Spanish chat room. We have like separate discussions. So check us out. Make sure you jump in there if you want a good community to talk markets with. Also check out the trader funding program. All right. That if you want to try to access, we had 3 live accounts, 3 accounts go live yesterday. That's cool. Like in one day, we had like 3 people qualify for their larger trading accounts yesterday.
That was awesome.
What's that?
That was awesome. Yeah.
It was awesome.
3 drives.
What's that? There's a 3 drives. Yeah.
Everything comes in 3s.
So we had 3 people in that are taking their assessments qualify for the larger accounts. So that's awesome. That's what it's all about, and we hope to foster more bigger and more, traders that, that are in our community that do well. So anyway, I was going to go back to Forex Analytics. Sorry. Let me pull up here's the data flash. You can see that. Let me pull that out of the way. Pull up the chart. How much time do I have, Stel?
A minute.
30 seconds.
Oh, good. Okay, I got a little bit of time. Let me grab the S&P just so we can see how the S&P is reacting here. I'll keep that on a 15-minute chart. The dollar index, actually, you know what? I'm not going to keep it on the dollar index. I'm going to put it on the dollar yen, which is, unreasonably strong at the moment. So here's the data. This comes with your Forex Analytics subscription, by the way, the data flash, which will allow us to see the data as it's being released, just like Bloomberg would. Which,
any second.
Frank, is my only thing that I really used on Bloomberg, was looking for the data when it came out. So must be some strong data. I'm not seeing it yet. I haven't seen it pop up. Have you guys seen it?
Nope.
Oh,
Don't see it on Twitter either. So
no, it's core PPI 1%. There it is. There it's starting to populate.
1.4.
So, came in a little stronger. Not any reaction. I mean, stocks.
What a surprise!
Really
Inflation
strong.
surprising to the high side.
Yeah, Euro's back down. I mean, Euro's still trading heavy, just right back down into support. Sterling right into the 130 level again.
Not a huge reaction.
Not a very big reaction at all. Yeah. Interesting.
What are yields doing?
Let's see. I mean, I thought yields were going to show a reversal yesterday, coming out of this wedge. And I mean, we started to, and we got through support, and then we bounced right back. It's just like that dollar yen. You look at the dollar yen, and it's right above 126. I mean, we broke 20. We were at highs that we hadn't seen in 30 some odd years, maybe 20 some odd years. I got to go back and look at the charts with the dollar yen, but really big move there. And yields just pop right back up again. So, well, we'll see if the market looks at this data any closer into North American trade. But I want to say, hey, thanks everybody for being here. Dale, you have your interview?
Yes.
Mr. Blanchflower is here. Excited to hear Danny Blanchflower.
Can you hear me?
Oh, there he is. All right. Well, then I'm going to turn it over to Dale. Thank you, team, for being here. K-Man, Stelios. I didn't see Steve around here, but and thank you, Dale. Have a great interview with Mr. Blanchflower, and I'll talk to you guys soon.
All right. Thank you, team, for making a lot out of not much this morning. So, Danny, welcome back. Welcome back to F.A.C.E, Danny. Great time to have you.
Of course, as I said on Twitter a minute ago, about to go talk to my pal Dale.
All right. Well, that's great. You want to show your mug on this interview? And I'm also
no.
Okay. All right. I want to at least put up.
It's a little early here.
Okay, I understand. I want to show what we're going to be talking about today. And for those of you who don't know Danny, he's a professor at Dartmouth. He was on the MPC, during the last Great Recession. And he's a labor economist. So his heart is with the working class and how difficult it would be if Fed policy made errors, which he believes they're doing again. But you know what, Danny, I'd like to start with this because I've tried to explain this to myself, to traders, to friends. How did we get from a massive unemployment problem that we needed to support during COVID, all of those millions of people, and unemployment, for a short period of time, went to 14, 15%. How did we go from that to having a labor shortage that they call the Great Resignation? Where did everyone go? I mean, did they use their government checks and they made money on crypto or meme stocks and they're retired? Where are they?
Well, some of it was, two parts to it. The first part is that the supply chain really bottled up, not least because people were forced to be at home. So it was really very difficult to make cars and transport things and so on. So this is basically a supply side problem. But then people essentially were sent home. Some of it they were given payments to stay home. There were furlough payments, but a great deal of it has to do with fears of COVID. And here I am teaching at Dartmouth, and we're back to 2.5 years in, and cases at Dartmouth have tripled in the last 3 days. And so people are fearful. I mean, people are fearful of what's gone on in this world. I think the argument that always gets to me is, yeah, they call it the Great Resignation, and people have resigned. But so there's been a big increase in retirements, but there hasn't been a commensurate rise in social security claims. I take the sense that a great deal of this is about people doing this for now. They're worried, particularly women are worried about going, they've got kids, they're worried about going back to a workplace where people have got COVID. And this COVID crisis sure as heck isn't over. So I think it's that. I think people have also realized the value of their leisure time is higher than they thought. Leisure time in the sense of home, looking after my kids.
Instead of 2 hours in the car commuting.
Yes, I think that's right. I think, and Danny Kahneman, who won a Nobel Prize in economics, he has a paper which shows it's a study of 1,000 professional women. And they were asked, what was the thing that made you the most unhappy of all things in your life? And the answer was commuting. So people have sort of revalued things. So that's what's gone on. Remember, when we say that, everyone says, oh, the labor market's tight. It's abject nonsense. If you look at the employment to population rate, that's well below what it was in 2020, well below what it was in 2008, and well below what it was in 2000. So what's happened is that people have withdrawn from the labor force because essentially the job wage offer is too low compared to the alternatives that they're doing. So there's an adjustment problem going on, and people are sort of rebalancing their lives. So that's what's happening. Some of it, actually, we see these wage increases. Some of it, what we know is that around the world, people who were on furloughs, they were on 80% of salary, have now come back out of that. And the wage increases we're actually seeing are about people going back to their normal wage. They're not really wage increases, they're just readjustment. So I think the answer is that we're still in disequilibrium with an economy adjusting. And now what we've got is we've got new waves of COVID, and 1 in 13 in the UK have got COVID, and we're seeing a war. And so we have to look to sort of historical perspectives and get realistic. And this inflation is not driven by central bank action. The action was driven because of a huge negative shock to output.
Okay, that's different. I mean, there are a lot of people, scapegoating Paul, saying he stayed easy too long. I know you were a proponent of, you felt comfortable knowing that Janet Yellen, who got Ben back on the team when they sang Kumbaya, and then after the COVID shock that they came in with bazookas and
what else could they do, Dale? What else could they do? I mean, really, what other option did they have? None, right?
Right. And so, I mean, there are still guys out there saying, well, they predicted that if all this fiscal stimulus came in, that it would just create too much demand during the supply shock.
Dale, the thing in a way which gets me about that, and the column which we're going to talk about that I wrote today, is kind of relevant to this. So if you go around the world as I do, and there's a great data release I had from the OECD this week, everywhere in the world has got this problem. Turkey has a 50% of inflation. Italy has it, Spain has it, Ireland has it, everywhere in the world. So how do you explain that? Presumably what the Fed did, or what happened in the United States. I mean, obviously the biggest economy in the world, but this isn't a Biden problem. This is a global problem. We've had a global pandemic, just as we had a global financial crash in 2008. So for anybody to argue that this is just about what happened in the United States is an idiot. I mean, that's just simply nonsense. How do you explain that it's true in every other country in the world? Because there's something global going on, and it's called a global pandemic.
Right. Okay. Point well taken. And when we wrap our COVID discussion up with the way China is handling it with zero tolerance, your view on that. The U.S. has put out travel advisories not to go there, or Hong Kong, that for sure you're going to be in a government installation, quarantined for 14 days. This is going to have an impact on the global economy.
Yeah, of
with
course.
China's China's economy slowing.
Well,
right?
of course, with the shutting down that we're seeing there. I mean, I just think, in a way, I've said to you on this show many times, this isn't over. We don't know the path of this thing. And of course, you know, people can, and I've always quibbled with people saying the Fed is going to do X numbers of rate. How do you know? Guessonomics. The data is going to be crucial here. We don't really know what's coming. And the paper I've written just talks about the fact that essentially we have two data points. We have a data point from 1916, 1914 through 1929. Where a giant shock, a pandemic, a financial crash came. We have data from 2008, and we have data from today. And that precedent is problematic. And much is going to depend on the data. Much is going to depend on the data that we don't really understand. And if you think this baby's over, you're foolish. And so it's proved. And I think that what we've gone to, and I've said it to you several times, this is guessonomics. I have no clue what's coming. The Fed doesn't really know what's coming. We will have to watch the data. And the plausible position is A, there will be no rate rises, and B, if this thing continues, there may well be rate cuts. I wouldn't rule that out. But anybody, I mean, all these financial institutions saying there'll be 5 rate rises by whenever it was, they're just making it up. They don't know. We'll wait to see what happens in the data, and the data are not good.
Okay, what do you say to the economists that say that consumers are still in good shape? They have great balance sheets. Their houses are worth 100% more than what they paid for it. Their IRAs have come back. They're doing okay. That they have they're claiming that consumers have good balance sheets, but at the same time, we were talking about the increased use of credit cards now.
Right.
That perhaps people are starting to live on credit.
Well, I mean, obviously, I think one of the greatest puzzles that has existed has been, if you read the economics literature, a shock comes along, and what you expect people to do is to do precautionary saving so that they have a buffer when the next shock comes along. So basically, the surprise has been people basically haven't done that. They've spent like gangbusters. But what we've seen around the world, yes, you may say that they're in decent shape. But the evidence is that consumer expectations and confidence around the world have completely collapsed. So predictive of recession in the United States is the fall in consumer expectations, both in the Conference Board and the University of Michigan, that tracks almost exactly what happened in 2007. In the UK and in Europe, we've seen collapses in various measures, particularly the fears of unemployment measures, which are predictive of big jumps in unemployment. And the ECB sensibly basically has been following that. Things are rising, unemployment's coming, and will not raise rates this year because that is predictive. And I think you're showing this chart. You're showing this chart.
That's tomorrow. What's Lagarde going to say then?
Well, I think they're going to have to say that the fear of unemployment has risen a lot. We're going to wait and we're going to watch, and we're fearful of what's coming. I mean, look at that picture. Yeah. So this is a picture, and I think it's indicative.
It's worse than the bottom of COVID, and that it didn't last so long. But
this is so actually during COVID. So this is the UK, just a survey in the UK from 2012, and it asked people, and we had the same things around the world, and they collapsed everywhere. But here's a little typical one. So this is during COVID, things weren't that terrible until you get to about March 2021. So that's a year in. You know, things dipped, but they got better during 2021. So that is British households' views of their financial prospects in the year ahead. And any measure you take around the world, it looks like this. It's dropped off a cliff. I mean, what's interesting is it didn't happen during 2020 because people's finances were protected by government action. So, and in a way, the fear that I have, and it's sort of back to the things you were talking about earlier, if people think the share price of company X is going to fall, it's going to fall. And if people think the economy is going to tank, that means it's going to tank, because despite what you said to me that people are in good shape, it appears that their consumer confidence levels have tanked and they think everything's going to get horrible. So why would people spend like crazy if they think everything's going to get horrible? Every expectation is that everything's going to get horrible. So
they say you can't get an airline seat, and hotels are booked.
Well,
is this the consumer's last hurrah? Is this the last hurrah this summer?
Well, I understand that, but there are bottlenecks. There are supply side bottlenecks But an
Okay.
example is that we've obviously seen declines in production, the availability of stuff. I mean, the airlines got rid of all their planes, so they just don't have enough planes, right? But the other part of it is, in fact, around the world, the reason you can't get an airline seat is because the crews are all checking out with COVID. And so that's the reason they can't fly, because they haven't got a crew, or in combination with the weather. So this is about COVID. It's about people's views on the world. It's about supply side shocks, and a central bank that can't really, I mean, it can't fix the inflation problem. Well, it can fix it by causing a giant recession, which looks like that's what's happened, because the financial markets have done the job for the Fed by fiscal tightening that, in my judgment, is going to generate a recession.
Okay, I just want to talk about what you had the last time we talked. You had a happiness index.
Yes.
And it showed that, we were headed this way. Certain states like California, people were already very pessimistic. I believe that was before the war. That was before another wave in COVID.
Right.
So I guess, the news that you're making today is most economists that are even, concerned are saying, well, yeah, because of Fed policy, we could be in a recession in the next 12 to 18 months. And you're saying it's pretty close to right now we're there.
Well, I think if you look at it, so the column that you're looking at links to the technical papers that we did.
Right.
The best analogy is there's two parts to it. The first part is that we don't really know when we're in recession at the time. So look back in 2000 and the Great Recession. So the Great Recession was called in December 2000 as having started in December 2007 by the group. We basically say to them, you call this thing. So it's the NBR. I'm a member of I'm a research associate at the NBR. The NBR Business Cycle Dating Committee dates the start of the recession. In the US, they dated December 2007 in December 2008. So it took them a year. And the problem at turning points is that actually data gets revised, and it gets revised downwards a lot. So the problem is we don't know when we're in recession, right? That's one of the big problems for policymakers. So if you're in it, it's probably going to take a year for you to work out that you were in it. But the data that I talk about actually predicts it between 6 and 18 months ahead of time. And it's never got it wrong. So these data are predicting entirely consistent with where we were in 2007, that we're probably in recession now. Maybe untrue. It may be the first time out of 7 that it's got it wrong. But it's predictive that you don't know when you're in recession. It takes a while to know it. The worry is that you behave as if you're not in recession. And I think the evidence appears to be that the UK is headed for recession, Europe's headed to recession, and probably the United States is as well, based on any forward-looking data that we have. Now, other people can say that's just not true, but these data predicted it in 2007 and 8, and all these commentators and all the central banks and everybody else got it wrong then, and they were saying the same thing.
Yeah, I really love this paragraph up here, Danny, where you give people a little historical background of, how history doesn't exactly repeat, but it rhymes. But here, I
actually wrote that, Dale. I wrote that. I actually first off wrote history. It doesn't repeat itself, but it rhymes. And the editor said to me, Danny, do you really think it rhymes? Don't you think it's just repeat? So I took out.
Yeah.
I took out that bit that I actually initially wrote that, and I took it out and I wrote, history, it seems, does repeat itself.
Yeah, it's exactly the same sequence.
So look at what you got there. It's an amazing two sentences. The Great War, an influenza panic, and a pandemic, and a financial crash, which started in the Florida housing market, occurred over a 15-year period. And then we get a crash that started in the Florida housing market, a pandemic, and a war on the European continent. That seems like precedent, right? So we look back and we say, what happened? And what happened was that people underestimated how long the pandemic lasted for, and the effects of it. I just think the danger is that you make stuff up. I mean, look at the quote, a famous quote by Mervyn King, was asked in September 2008 what he thought was going to happen to unemployment. And he says, so if you go to the top, Dale, go back to the top. Yeah, so the governor of the Bank of England in September 2008 We now know the UK economy had been in recession since April of 08, and they said to him, just go down a little bit. They asked him, what do you think is going to happen to unemployment over the next year? And he said, I don't think we really know what will happen to the unemployment. At least the Almighty has not vouchsafed to me the path of unemployment data over the next year. So the governor of the Bank of England had absolutely no idea the economy was in recession and that the unemployment rate was going to rise. He actually also said, I was sitting 2 seats from him, and he also said he may have told Danny. He actually was, well, yeah, anyway, I didn't put that in, but he literally said he may have to Danny, because if you go back and read 2 questions earlier, I lay it out very nicely, and I say unemployment is going to rise, and it turns out unemployment rose from 5.2 to 7.9% over the next 12 months. So if the governor of the Bank of England has to appeal to the Almighty, has absolutely no idea the economy's been in recession, no idea the US has been in recession, then we should worry about what people say, what the markets say, because they all went along with this, and what policymakers say. If the governor of the Bank of England has no clue whatever, and the danger is that you get overtaken by events.
Yeah, like here, all the signs that another recession is on its way in 2022, yet policymakers have missed it again. So what data do you think would get the Fed to pause? Would it be a big break in
the data that I've talked about are what I call the data from the economics of walking about. So is that your YouGov's index of households? Yeah, that's the YouGov. So the example of what do consumers say, what do firms say, what do the purchasing manager indices say? Of relevance, of course, to the Fed is what's happening around the world. If Europe and China look like they're weakening, that's relevant to them. But I think that the answer is that they have to be very cautious to focus on things. They want to focus on things that are timely, like these surveys, that don't get revised, and they need to worry about looking at GDP numbers. They'll get revised forever. Unemployment rates are not nuts. Look at what happens to the labor market, but those are lagged indicators. They don't move much until after the recession has started. So the careful thing is look at the precedent for 2007. So what happened in 2007 was the housing market then moved to consumer confidence. Then it moved to real measures like retail sales and so on, and then eventually moved to other stuff, to the labor market things and so on. So I think the answer is you look back to precedent, you look at what happened in 2007, and you say, are these indicators moving? And get into your mind that inflation is temporary. Inflation, everything we've ever seen in the history of inflation, it's spiky. And inflation comes and inflation goes. And the danger is that for anybody who says the Fed should raise rates and so on, what they have to understand is that that has consequences. That has consequences for output. And the question is the solution to your inflation problem something worse?
Right. Like, how do interest rates affect the supply and the yield on crops?
They don't. They simply don't. I mean, the reality is that we're probably going to see warfare in the southeastern Ukraine, which is one of the great producers of wheat.
Yes, wheat. That's
going to impact the price of wheat. But what's that going to do with the Fed? One of the other things, Dale, I've seen is that the cost, the shipping costs, the freight shipping costs.
Oh, Baltic Dry Index.
The Baltic Dry. I write about the Baltic Dry. If you go look at the Baltic Dry, since the beginning of March, I mean, who knows exactly what's happened, but the Baltic Dry was the index that collapsed from May 2008. This index is at relatively low levels now. Whether you take it seriously or not, it's down about 30% or so since the start of March. So I'm looking at these indicators that told us about recessions coming, and I'm fearful that people do not understand the consequence of a rise of what happens if you get rid of inflation. So the story that I've worked on, I always have in my head a 1 percentage point rise in inflation compared to a 1 percentage point rise in unemployment, which is maybe what you'll create by trying to slow inflation. It's 5 times worse. So a rise in unemployment, it's in well-being terms, how people feel, is 5 times worse than a rise in inflation. So you better be careful what you ask for. You say the Fed should be raising rates, but it has nothing to do really with the causes of inflation. And what you're going to do is you're going to push the economy into recession. And that looks like what the markets have done, because they've generated tightening across the yield curve.
I've never seen a bond collapse like this, maybe since
Why do you think, Dale? Why do you think that's happened?
Well, because the Fed stopped buying, and there's not a lot of people coming in to replace their buying.
Right. And so listen, think about what that's going to do to confidence. I mean, there's another story I like, but I don't like. In the UK, the survey of the Institute of Directors. So that's a group of bosses of companies, and their index in March collapsed. So the question around the world is: is consumer confidence collapsing? What about business confidence? If that's going to collapse, that's recession, because they're not going to hire people, they're not going to invest in things, and investment started to look weak as well. So really, what the markets are doing is they're really trying to bite off the hand that feeds them.
Okay, so we're in the midst of a sovereign debt crisis, possibly here. Let me ask you this: the market and narrators aren't really talking much about what's happening with the potential for a Russian default, which was a big deal many years ago, and there was a recent default, I believe, in Indonesia.
Yep.
So we're starting to have these things occur. Is it a big deal if the Russians default on their debt like it was in, I think, 1997?
Well, I always like precedent, right? So where are there examples where a giant country defaults? And where are there examples of what happens? So what you just illustrated is, I mean, I always think collapses in financial markets have huge effects, have ripple effects around the world. There aren't really any examples. I mean, what you said, I think, was hugely sensible. The question is, do we have examples of financial crises that don't have lasting long-term effects? I mean, you asked, is this just a no deal? I think the answer is, any precedent we look to suggests that it's likely to be a big deal, right? A major country defaults on its debt. That's going to presumably impact trade relations and trade relations around the world. I mean, again, this increases uncertainty, because Dale and Danny don't know what this is going to do, but they don't think it's good.
Right. And European banks probably have more exposure.
Presumably they have more exposure. Some of the reasons why presumably Christine Lagarde is very concerned. I mean, I look back and think about what happened in 2007, 8, and 9 when British banks, RBS and Lloyds fell. What were the implications of that? That, I think, was where they were rescued, but the biggest implication was that. And then there were European banks that failed, and there were European banks that were tied. I mean, there were the German banks that were tied to subprime loans in Detroit, right? And so what we didn't really realize, I mean, I remember Gordon Brown. Sorry?
The tentacles of debt.
Yeah, the tentacles. I mean, Gordon Brown, I think, famously said this. He said, what we did prior to 2008 is we tried to simulate what would happen to a single bank failing or a single country defaulting. He said, what we didn't do was to simulate what would happen if the global financial system went down. So it's the tentacles, right? Nobody quite realized, and should have, what happened. I mean, so back in 1926, the Florida housing market collapses because of a giant hurricane and the end of a boom. But then it's 1926, and then people start to default on their mortgages and on their loans, and that generates failures in the banking system, and eventually it spreads, and it leads to the great crash of 1929, which has implications all around the world. So I think that this is I mean, we're talking, what does globalization mean? It's what you said, Dale. It means there are tentacles of everything everywhere.
Best advice you give the man on the street to prepare for it? Is there really any way to prepare for what we see ahead?
Well, I mean, I think that I do think that people are fearful. I think they're hunkering down. If you say your financial prospects are weakening, I mean, in a sense, that certainly looks realistic. I mean, I have the sense in the work that I've done is, in contrast to economic forecasters, people actually have a pretty good idea what's going on in the community in which they live, and that's obviously worrying for them now. Yes. I mean, it's hard to know what's coming. Confidence in central banks, and think about confidence in government. I mean, in the UK, we've seen the Prime Minister and the Treasury Minister being fined by the police yesterday for illegal behavior.
Right.
The confidence people have in their leaders in a time of war. I mean, and what's happened in the UK is the Treasury Secretary raises taxes, and now there's a huge, not just about him being fined for illegal activity, but they found out that he had non-dom status, hadn't been paying taxes, even though he raised taxes on himself. So the confidence people have in markets and leaders and so on is really plummeting. So I think we have and obviously the story in France where you just had a discussion about whether Le Pen is going to win, but the support for Le Pen presumably doesn't come because people think everything's going great, right?
Yeah, that's interesting. So, everything's confidence, consumer confidence,
Yes.
confidence in our leaders.
Yes.
And I heard the expression once, Danny, the difference in confidence is knowing what the con is.
Yeah, and there's another one like that. So in economics, right? So economics and econometrics, who put the con in economics? Economics, who put the con in econometrics and no, exactly. Yeah. And what people are realizing in many ways is they shouldn't believe what the experts say, and that's a great deal of what's gone on, right? They shouldn't believe anything these people say. And that in a way is dangerous in markets, and it's dangerous in politics, and we need to worry about it. But to actually argue, you have the faintest clue what's coming, which is what I hear in financial programs all the time. And I listen to, company X says the Fed's going to do this, and it's like,
right,
you have no bloody clue.
Well, Paul doesn't know.
What?
So how would they know? Jay Powell doesn't know.
Absolutely. Well, Jay Powell doesn't know. That's why Powell and Blanchflower tend to be pretty close together in a sense that, he gets pushed around by what the markets are saying. But basically, he says, we don't know what's coming. We're going to go and look at the data. I thought Brainard's speech this week was moved away from that, saying, it's clear we're going to tighten. Well, okay, how do you know that?
And she's a dove. Yeah.
Well, she's a dove, if the doves have moved in that direction, but I think mindful, and we should be talking about, I think in a sense, what's coming is that the Fed and commentators are going to be hit very hard because one of these days, some really bad data, and shortly, some really bad data is going to come, and then that's going to knock their socks off.
Okay. Maybe it'll be an NFP.
Yeah,
so,
right. Well, exactly.
Like
but that tends to lag a little bit. But I suspect we're going to see some really bad data, and that's going to make markets suddenly go, oh, goodness me, they're going to have to reconsider. It could be that, maybe we'll start to see these inflation numbers coming down, the producer price number, but eventually the consumer and business confidence data lead into the real economy and real data, and that's what's going to scare people senseless.
Yeah, they will not be spending.
Correct.
And, I thank you for spending time with us today, Danny, and giving us your view. And another call, you were ahead of the game with your happiness index, and
thank you.
The weakest countries right now, you're saying is Sweden and Portugal on your YouGov's index. So,
they've been hit really hard, and what's happened in these countries is in March, the expectations of unemployment, what's going to happen to unemployment in a year's time, has exploded. Across Europe, people think we've never really seen increases like this. They think unemployment's coming, and the question is, what's behavior going to be? And it ain't good.
And we'll leave it with that. Everyone's warned. Do what you can do to prepare for it. And Danny, thank you so much.
Of course.
Love talking to you, buddy.
You too, buddy. Thanks.
All right. That's it. Danny Blanchflower, and you could follow him on Twitter. And his writings are ahead of the time. He's ahead of the curve, and
thank you.
It was great to have him.
Great.
So everyone, adios. Have a great day. You could join the team in 12 minutes on the Morning Edge. And remember, no matter what economic conditions are, don't just count your pips, count your blessings.
Yes, sir.
We'll see everyone tomorrow. Adios, Danny.
Yes, sir. Thank you.